Okay, good morning, folks, and welcome to a really quick coffee talk with Bob. And what I want to talk about this morning is U.S. jobs data that came out from ADP, and the number was a miss. And the extra added bonus for equity traders who are bullish was that ADP also reported that pay growth slowed for workers who changed jobs and who stayed with their current positions. So this is music to the ears of the Federal Reserve. Slowing wage growth and a miss on jobs data, and equity markets initially took a knee-jerk reaction higher. Why? Bad news is good news. Here's the problem that most traders aren't paying attention to. I was listening to a couple of folks that I watch on YouTube, and they're intelligent. They're talking about Fibonacci retracements, blah, 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 blah. What they're not listening to or watching are weekly resistance levels, nor are they watching the yield curve. This is as of the close of the 28th. We rallied, weekly chart, rallied on the triple Qs up and into the upper band of resistance. What did we do in the final minutes of trade? We added to shorts. The bet being that if we do hit this resistance level, you're going to have a supply zone up here where sellers will be selling into that strength. Now, maybe I'm wrong. What if we do manage to close out the week above this upper band of resistance in red? Well, then we stop out of the trade. We take a small loss and we look to add to long positions. It's as simple as that. But there is a bit of a problem out there, and I'm going to be watching it throughout the day, and I could just use the CNBC mobile app to just keep an eye on this chart here, or this graph here, which is two-year yields down, and 10-year yields, which are also down. But there's a problem. While both are down, the 2-year is down greater than the 10-year. What does that mean? It means a steepening of the yield curve. And what traders shrugged off yesterday, it can happen. It won't happen for any length of time, but it can happen. The yield curve on the week last week ticked up. Now, when we look at the pre-market action, equities are still up somewhat. And this is the NASDAQ 100. But look over here, this box here. As a matter of fact, let's go to, let's do this. This is the 2-year. I'm going to overlay here the 10-year yield. And you can see that while both are down, you may be saying that's great, interest rates are going lower, that's good for the consumer. Yeah, but it's also indicative of recession. And don't forget about the big box retailers that came out last week. Dick's Sporting Goods, annihilated. So you could see that the 2-year yield is down twice as much as the 10-year yield. This is a very, very big steepening of the yield curve. Now, maybe it's not going to close this way. Maybe they'll reinvert by the end of business today. We're not seeing a major sell-off in equities whatsoever. Tesla up top here is down fractionally. VIX is doing nothing as it normally does, at least in recent months. The NASDAQ 100 up fractionally, but it's threatening a breakdown here. Look at the head and shoulders setup, and this is only a 1-minute chart. So beware. Beware today of getting overly long of this market. While we broke out, and we want to be very, very open-minded and very, very fair, that while on a weekly basis we are at resistance, we did in fact close above daily resistance as well. So the number to watch on the trip Qs today is 374. 374, we closed down below there. We may get a continuation pullback in the rest of the market, but just keep in mind that we do have PCE coming out tomorrow. That's the Federal Reserve's favorite inflation gauge. We also have non-farm payrolls coming out on Friday. So a minefield worth of economic data coming out this week. So buckle up. This week is not over. Members, I will be putting trade alerts in our Slack forum if and when we do execute on any new trades. I'll talk to you soon. Be well.